All right, just to tack on from what Blue Chip Trader had to say just a little bit ago, we've got the markets trading at session highs. S&P futures now trading the 2608.5 level, and I think this is as good a time as any to bring in Brett Manning, aka Chart Trader, to help us get a sense of where we go from here. But first and foremost, welcome back, Brett.
Hey Jim, how you doing?
I'm doing. If I'm going to be honest, man, I am looking forward to a hot cup of soup, some tea, and a very long nap today. I'm a bit under the weather.
Yeah.
So
I know how that feels. All five of us in my household were there about a week ago.
yeah, well, it's contagious. It went all the way from where you are to me. So, and I usually rebound pretty quickly, but this one's got me. So hopefully by tomorrow we'll be back 100%. So. All right. Well, enough about me. Let's talk about you, man. How is the market treating you, and where do you think we are as far as testing this 2600 area in the S&P?
Well, so I've been looking for a test of around 2625 to 2650 in this bounce.
Mm-hmm.
And I started kind of putting that target out there maybe about 2 weeks ago. And most of my trading has been from the long side during that period. But it comes out of a period of what I think is some of the best action, some of the most profitable type of trading environment particularly for the style that I use, that we've seen in a couple years anyways. And so I've slowed it down a little bit at this point, and I usually do during the first 2 weeks or so of earnings season.
Mm-hmm.
It's typical for me to slow it down at that point, and so I'm just kind of trying to make sure that I don't unnecessarily put myself in a bad situation. I think that's a common problem for newer traders, is if you have a period where you have some extraordinary trading over the course of a month or two, you tend to expose yourself, or you get, I think, more vulnerable to a particularly large drawdown because you feel a little bit overconfident and you feel like if something starts to go against you as the market starts to shift in terms of how it's behaving, you feel more likely willing to take bigger risks to get back to black on a day. So you're particularly exposed to the potential for a serious down day. And I've been through that kind of process before in the past, and I've learned my lesson, and now I know that when I have a really good stretch, especially when I come into some period where I know it's probably not going to be quite as easy, at least for a period, and in my experience the first couple weeks of earnings season is that, then I know to just kind of take a deep breath, take a break, step back, and wait for a new context that looks interesting and inviting. So I'm kind of in that process right now, even though if I was trading today aggressively, I would be long right now, the long side, to fulfill that target of looking for maybe another 10 or 15 or even 20 points to the upside, especially with the way JP Morgan and Citigroup are acting at this point, coming off of less than inspiring reports and turning around and ripping. So and maybe we can talk a little bit more about that, but that's an important signal for the market.
Yeah, actually, I do want to talk more about that. And you had highlighted, was it KRE or KBE?
KBE,
okay.
Big banks.
Okay, so I have that one on the chart right now. And when you highlighted it, we were down about 1% in that KBE. Now we're up about 0.8%. So pretty impressive reversal to the upside here. Why don't we talk about this and how this action in the banks is going to translate into your overall trading strategy going forward? How is it going to relate?
Okay, so, I mean, the leaders in that move, that rebound, are JP Morgan and Citigroup, the two banks that have already reported. And that's important because, we saw a top-line miss from Citigroup, we saw an overall miss from JP Morgan, but, what the analysts were expecting isn't what's important here. What's important is that the bank stocks led on the downside during the correction that we saw in the fourth quarter of last year. Mm-hmm. So bank stocks and small caps were really the downside leaders. The bank stocks were clearly one of the principal core components to really unravel during that process. And so that was the market starting to make assumptions about downside risk potential coming into this quarter's reports. And that really has to do with, the idea that we could be seeing a deteriorating economic environment to the point where we might even have some recession risk starting to pop up, and that would really be the undoing of the banks who maybe were over leveraged with exposure to, among other things, triple B debt and emerging market debt, particularly dollar denominated debt. And I think that was kind of like the real scary monster under the surface, and trying to understand how much to appreciate the potential downside risk there. I think that's why they really unraveled as dramatically as they did. Now, with these reports, we're seeing the market relatively clearly say, maybe the downside pricing put in here was an exaggeration of the real downside potential. After we hear from these companies, we get a sense of, what's going on underneath the hood. It's really not as bad as it was possibly cooked up to be during that corrective wave. So that translates into, I think, an overall market view, and probably makes it a little bit easier for the market to rally. At this point, pushing through resistance levels, pushing through that 2600, and starting to get to what I call the capper. And I think it was last week, I posted maybe Friday, an ETF daily notes called Looking for the Capper. Mm-hmm. Basically, that there's going to be some kind of blow-off move in this bounce, because there's been the sentiment data that we saw into the lows was truly historic kind of panic across the board, like every different indicator showing just, really extraordinary levels of a bearish sentiment and of a panic sense in the market. Huge hedging, not necessarily discouragement, but panic. And now coming out of that, the next thing that leads you to have to infer is that this bounce, there's going to be plenty of people who have been fading it all the way up. Sentiment doesn't change that fast. So a bounce out of something like that tends to have legs because, it doesn't happen at all without something fueling it, and whatever's fueling it is pushing against probably increasing short interest that eventually gives up. So I think we're pushing through that process now, and the capper is really when we kind of exhaust that fuel of that final short covering bang. And we may be pushing into that today, and that's the type of thing that can take us up to test that 50-day in the S&P and blow through that upper resistance level defined by the bottom of the range in November. You blow all those orders out, and that's when you can finally say it's safe to start to try to fade this market. You want to wait until after the weak hands are off of the bus you want to get on before you get on that bus. So anybody who's been shorting this market, whether they were strong-handed originally or not, are probably pushed into being weak-handed shorts at this point, doubting the thesis because they've seen the miss by JP Morgan, and yet it's rallying. They've seen enough points like that suggest that it's tough to hold on to positions if you're out of the money fading this market right now. It's more likely probably that people will give up. And I think we're seeing some of that today as we push through levels, and I think that it probably will extend, but I think that will lead to an interesting shorting opportunity after we kind of blow out that side of the market.
Okay, what are some of the other things you're going to be waiting on? Because I suspect that you're not just going to jump right in at 26, 25, 26.50 and just start shorting the market. I know you're going to be looking for some other variables to construct the trade, so what are those?
Well, one of the problems is that it's happening right now, right during the first week of earnings season, and I want to try to explain why I tend to feel like that's a less productive period for me. And the best way that I can do it is like it's because the forces that are driving the market. Well, I do a lot of my trading based on how I see orders coming through and how I read the tape, given my construction of a context. I have a sense of what the market context is, and everything to me, we've talked about the tape composition model idea. Everything to me is understanding weak hands and strong hands on both sides of the tape and trying to figure out where vulnerabilities are. And so that's kind of like watching a chess game, and trying to figure out which side is likely to win. And every moment of the tape and of the evolution of the pattern is like snapshots of the pieces on that chessboard, and you're trying to figure out, based on looking at the configuration of pieces, who is likely to win. And the intraday tape is a big input in that. And one of the problems during the first period, for the start of earnings season, I think that the types of forces that are at work are playing different games. You've got a lot of institutional money that's just had, sort of strategy meetings and figuring out what they want to implement for this quarter based on, how the research that they've purchased and their own analysis suggests the situation, and they make bigger moves, and the moves aren't really related to what's necessarily happening that day. So the way that I would think about this is if you think about a picture, a snapshot of that chessboard and the configuration of pieces, during the early part of earnings season, in my experience, it's kind of like if you imagine, when you're looking at that snapshot of chess pieces, if you imagine suddenly that you find out that it's actually a picture of a chess game with a bunch of overlaid transparencies of different pieces and configurations, and you start to pull them apart, and you realize that you're looking at a composite of a number of different chess games, and trying to figure out which side is going to win the game that you thought was being played. Suddenly the pieces don't make sense anymore. What you're seeing doesn't actually indicate the arrangement of pieces on a particular board. There's not one game being played. There's lots of different games being played that are being overlaid. And watching the intraday tape and the patterns evolve suddenly becomes less indicative of how patterns are going to resolve, simply because some of the forces at work in driving that configuration are playing completely different games from one another. And so it's just not as reliable. Certain setups just don't work out quite as consistently. But to get the exact opposite of that kind of situation, if you look at the last week of the year, everybody was playing the exact same game. That was with the VIX up where it was in the 30s, and there not being major earnings inputs happening right then, and everybody trying to take advantage of that volatility one way or the other, or protect themselves from it. The moment-to-moment changes in the market were completely indicative of what was happening. It was a single game, everybody was on the same board, and there was a war going on. And so it was much easier to trade, particularly given my approach. So I'm kind of, just to go back to your original question, if I see that level hit, I'm far less likely to take it than I would otherwise be. If we were in a different situation, a different, well between earnings seasons and not a lot of clear fundamental headline drivers for the earnings growth picture, then I might, based on short-term pattern structure, go ahead and try to put on that fade. But at this point, it seems unlikely that I'm going to do that unless I see a really killer setup, and just in terms of how the market behaves. And one possibility would be really good news that isn't able to produce much upside after it gets to the level where I feel like more of a capitulation by shorts has already happened. That type of feeling to the market, where there's sort of buyer exhaustion, particularly exhausting the fuel of people who've been trying to fade it and who have already given up, that would probably be the greatest likelihood that I would take that trade right now. But this week, during this period, as we're just starting to digest our early information about earnings, I'm probably less likely to do that. It depends on what I see.
All right. So would it be fair to say that you have somewhat handicapped what the next big event might be that would get you involved to see that blow off that blow off move that you're talking about? May it be FANG earnings reports sometime after that. Is there something in there or something else that you've handicapped that's going to get you interested? The next key point, I guess, is what I'm asking.
Yeah, I don't know. I mean, it could be something that happens relatively quickly. It may not be. I guess it really just depends on what I see. I don't want to pin myself to something. I think that's going to make it less likely to see it when it happens.
Okay, and that's fair. We do have a big event coming up later today, in the Brexit vote. How big of an event is it, and is it going to factor into your overall strategy?
I suppose that obviously May's deal is going to be defeated. Everybody knows that. And the question is it going to be such a lopsided process that it could really destabilize the British government? And I don't really know. Event would know better than I do, but I'll probably take my cue from his early analysis as well as what I read. I have a feeling that it's probably going to be less important than maybe it seems.
Okay.
In general. But, that's probably been my weakest area of analysis on a macro level over the last year, understanding the twists and turns of that, and I feel like that's been a productive lack on my part, because it probably would take, you need to basically get a PhD in that on a daily basis to really understand the intricacies of the process that's going on right now in the UK. Other than on a big picture level, I can certainly see that, there's the game theory of it is pretty clear in terms of reward and incentivization and where the larger players are positioned. But there's an internal UK level politics at play in terms of gaining control, using this as an excuse to gain control of a process that kind of fudges and muddles the process of analysis to a level that I've not overly invested myself in the process. So, I'm going to be probably in a position of assuming that it's not going to be an overwhelmingly large factor, and then quickly trying to catch up with analysis and reaction and understand if something dramatic has taken place that was not expected.
Okay, so it sounds like you are really content at just sitting out for a little while, at least picking your spots very, very patiently, and waiting on the next set of data points, whichever they may be, which it doesn't sound like you have even gone that far to really outlay what's going to be the next big thing that's going to get you back in that groove of trading a lot again, I guess.
Well,
go ahead.
Let me phrase it a little bit differently. So we're either in a cyclical bear market or a cyclical bull market right now, and that's not necessarily. I don't think the universe is deterministic, and it's not the case that one can know for certain one way or the other at this point. But if we are in a cyclical bull market, even though, to me, percentage declines is not the definition of a bear market. Whether it's gone down 20% or not is irrelevant. The mode of behavior is important. Mm-hmm. If we still are in the same cycle, then a panic low, like we saw in December, will be, quote-unquote, the low. If we are in a cyclical bear market, then a panic low is usually the first big low. And you haven't gone through a process of discouragement yet. And the evolution of data is going to basically decide that for us as we go forward. And the way that I would see that happening is, and I've talked about my whole Turtle Beach metaphor and everything, the process of risk aversion can start to, it's not so much that it moves from the market to something else, it's just a process. Either it's taken hold or not. Either we got enough vulnerability built into the system, enough overextension, enough acceptance of risk to cause a shift toward risk aversion to snowball and start to show up in terms of how households are behaving, and then that snowballs into how corporations are behaving and how banks are behaving. Credit becomes less freely available. Households start to save more. It's just a snowball process. And either that snowball process has kind of started to get traction or it hasn't. And I think that as we see data start to roll out in the first quarter, we're going to get a sense as to whether or not that's happening. And no matter what expectations from economists are right now, they can't know how that process is going to turn out. So it really doesn't matter what someone's economic projections are for the next several quarters. Every recession that we've seen, every major bear market that we've seen, until after revised data showed that we were in a recession, basically no economists really saw it coming. It's never the case that economic projections reflect the coming of a recession. Ever. I've never seen that in my life. It is that we find out, even in 2008, it wasn't the case. We did not know that recession started in the second quarter of 2008 on a very deep level until we got revisions like 3 quarters later. That's when we started to see that the economy was already in negative growth. You will not see it at the time, but the market will seem to be off its rocker. It will seem to be crazy. Why is the market going down so much? We're definitely not in a recession. Every time it's the same thing. So we'll start to see some of the data change, particularly in earnings, and we're not seeing it so far. We're not seeing sudden large guide downs. We're not seeing sudden big and striking misses. And you will start to see some of the economic data change, particularly in terms of ISM dipping sharply. And we're starting to see some of that globally, and I'm not saying this is going to happen. I'm just saying I'm waiting to come to a better understanding of myself if we are starting to see a more rapid than priced in sense of underlying deterioration. And I think that there are a number of different possible hallmarks of that. I think that the way that China is now moving into a more full stimulus mode right now, one of the hallmarks of that process is full stimulus mode, and then a month later it doesn't really seem to have made much of a difference. So that would be just watching how Chinese asset prices are reacting to the stimulus that they're doing would be important. We're hearing Draghi start to turn back toward, kind of getting away from that idea now of ending QE and raising rates. It looks like that's out the window at this point. And we're starting to see other markers around the world. We started to see some pretty bad PMI shifts. And if we start to see it show up in the United States as well, then this is all kind of in line with the idea that we're in a bounce right now that's destined to eventually make lower lows, rather than that we saw the panic low that defines a pullback in a continuing upcycle in the market. And it's just, I don't want to over-assume anything right now, because I think that it can lead to a situation where you don't necessarily see what's actually happening. And I like to be in a read and react mode. But yeah, I've definitely got myself into a place where I'm very willing to be more selective than I've been over the last 2 months. Over the last 2 months, I've been extremely active every day, and it's been a really terrific process. And I just get the sense that this is the time to pull back on the throttle a little bit and start to get some more conviction based on how I see things shifting over the next maybe 2 to 3 weeks. Start to get some more of a firm sense of what sort of context we're in, if that makes sense.
Yeah, it does to me. Gavin, did you want to jump in?
No, I was just going to, I wasn't sure when Brett would take the break, but I was just laughing about his comment, because I was just reading a book last night that had noted that economists had failed to catch the last 8 recessions, and markets had predicted 9 of the last 5 recessions. So
Yeah,
kind of plays into, yeah, exactly. Kind of like plays into what Brett was saying there, I think. So I was just going to throw in that tidbit. I thought he would get a kick out of it. So
yeah, exactly.
All right.
So be selective and don't rely on economic projections.
Exactly.
All right. Well, I can't let you get out of here without talking a little bit about crude oil. We actually saw that flush down through the mid-40s that you were talking about, yet I don't believe that I've seen you all that active in the crude market lately. So what's your take now?
So, yeah, I mean, it was almost like while that was happening, equities were just fish in a barrel for me. And I just kind of got into a zone with that. I focused on it because it was the right thing to do as far as capital management. But yeah, crude oil flushed down right to the level we talked about, right around 42, 42.50. That same June 2017 lows area. And that was, I think a capitulatory flourish at this point. And it was quickest back to the 50-day moving average on the continuous contract. And I would say that probably if I had been focusing on it, I would be less focused on it now, simply because we have blown out probably both sides of that tape for a little bit. If anything, maybe we push up through the 50-day to get just above the previous lateral consolidation that we saw in that market back before the flush, which I think is around that 54 level, which we were originally looking for a bottom at. So maybe we flush back above that, and then maybe we correct some kind of fib level, or maybe back to check 50, flush just under that, and we kind of form the boundaries of a little bit of a consolidative period. And I guess, the big picture is that there's a lot of policy issues with crude oil, but it's also starting, if you imagine crude oil going through the same process that I was just talking about going through. Like, crude is trying to figure out whether or not this is a cyclical pullback and an ongoing expansion cycle, or if we have started to shift into a process that will eventually unravel into something that can maybe be thought of as a technical recession, or at least enough of a slowdown that in relative terms it's kind of like a growth recession, or a pullback in terms of economic growth, where we go from GDP at 3.3 to GDP at 0.5, for a quarter or two. I mean, those sorts of things do happen. And if that's the case, that's going to keep a lid on crude prices most likely. But, there's a lot of moving parts there in terms of how the relationship between the White House and the Saudis are concerned, and the relationship between both of those parties and the Russians are concerned, obviously. There's a lot of moving parts in crude right now, but we did really kind of capitulate on the downside, I would say, pretty powerfully. So it's hard for me to see, an immediate fade without some kind of upside capitulation following it, like we're looking for in equities.
Okay. You ready for a listener question?
Absolutely.
All right. So, I was going to ask you about China anyway, so it's kind of on that theme. This is a little different than the question I was going to ask, but it is, what about the Chinese summit in D.C. January 30th through 31st? After that, do we have a bounce? Could that be the opportunity you were looking for?
So, that's probably going to come down to essentially whether or not we're going to be able to get a deal done with China by the 90-day deadline. And I still have the same view that I had. I believe that we are in a process where China is essentially stringing along the United States on trade talks. And I do not think that it's in their interest to hand this White House and this administration, the first China hawk administration that we've seen in the United States in decades, something that amounts to confirmation that trade protectionism and China hawkishness is a productive strategy for the United States to take politically. I think that that's more important and there's more at stake there than short-term shifts in their economy to the extent that they can be attributed to the tariffs coming from the United States. So I believe that the process that I would see as most sensible for them is the one that I see actually happening, which is to continue to offer hope for a deal, continue to make it about details, continue to express a willingness and a desire to make a deal, and keep the process going and keep killing time before inviting more extreme action from the United States. The tariffs that would prospectively be put on in March were tariffs that were threatened last September. So that's already quite a bit of time to have stretched out. And as we get closer and closer to the United States presidential election in 2020, I think that this is a process that will probably be something that is a hurdle and an obstacle for this same administration to remain in the White House after that point. And Donald Trump has already started to, according to reports that I've read, and maybe these are wrong, and I guess people have denied it, but there seems to be a lot of reports circulating that a lot of people in the White House who are the more super diehard China hawks have started to become concerned on some level, I guess, that Trump is starting to look for something that can make it appear as though he's got a victory in this, even if it doesn't actually amount to substantive change. And I'm not sure what China would be really looking for there, whether or not that would be okay. I mean, obviously they would rather not make substantive changes, but I think also they would rather not hand a trophy victory to Trump right ahead of the process of him beginning to campaign the next election. So it's an interesting process, but maybe there is the opportunity to short based on headlines that make it appear as though some kind of deal is very close to happening. If I feel like that deal is not actually going to happen, it's similar to a short actually that we had out of in Buenos Aires. You remember the meeting that he had with Xi Jinping?
G20?
Yeah, the G20 meeting, right. So the headlines around that, the press release put out by the White House suggesting that everything was taken care of, the trade war was essentially over, huge substantive change. That turned out to be a tremendous fade. Perhaps we see another moment like that.
I find it hard to believe that there will be a whole lot of substance coming out of this particular round of trade talks, particularly because of the timing. It's the end of January, and I think the Chinese New Year is like February 5th, so I just find it hard to believe.
Don't you think that they would, Jim, this is Gavin here, don't you think that they'd want to settle markets ahead of that, given, always concerns around liquidity for that week being closed? I think that they'd want positive comments just to keep the market settled ahead, no?
Well, China's closed, so I don't think it's they can. I've seen a whole lot of market turmoil during the Chinese New Year where markets are all over the place. China's closed. It's almost as if We'll just wait till the dust settle and things get back. I think if you look back at plenty of times during that Chinese New Year, there's been some volatility, so I would not be surprised at all. That's just my 2 cents.
Your 2 cents. I don't know. I guess I'm just looking for something to be marketed as great progress.
Well, it depends
Whatever
what side
happens.
you're looking at. I find
out of the United States.
Sure. But I think Gavin was talking about considering, it is Chinese New Year. They'd want China would want markets to be stable, right?
It's one of the reasons why they've been taking all these actions with the reserve requirements. They usually do that ahead of not the full basis point that we saw, but usually 25 to 50 basis points, just to keep markets settled, make sure there's plenty of liquidity for that golden week. And I would think that there's really no reason for them to get negative ahead of it. From what I can see, I don't think that either side would view it as a win. So I think that it'll be just kind of steady commentary, which I think would be enough for the markets, is my take.
Yeah, I was thinking more benign, nothing all that particularly triumphant on any direction. I think it just sets up, because of the timing, to be somewhat of a non-event, which maybe, based on what you had hypothesized, Brett, we might get some of that good commentary, but really it's kind of a smoke and mirrors type event, because really nothing's going to get done during that time.
That would be the type of thing to fade, yeah, exactly.
So maybe that's the particular setup, but that's still a couple weeks away.
Yeah.
All right. Well, any other markets that are catching your attention right now?
No, I mean, just continue to look really big picture and stick with markets that have been highly volatile and wait for the next step to evolve. I don't think, I want a final point to make here. I don't think that, and I've written on this a little bit, I don't think that while it gets so much media coverage that the government shutdown is necessarily that important to what's happening in markets. And so that could be another possible fade catalyst if there's some resolution to the shutdown that really pops the market. I have a hard time seeing that be something that's a sustainable upside, unless it is that we've resolved it because we've suddenly had this really productive breakthrough in terms of the relationship between the White House and the House Democrats. And that seems very unlikely at this point. But if that's the way that it resolves, then that could actually lead to a really powerful upside catalyst if it implies that there has been a new shift in the trajectory of that relationship, such that suddenly there are things on the table like a big infrastructure stimulus plan later this year, because suddenly there's this good and smooth working relationship between Trump and Pelosi and each gang. But certainly I would think that the declaration of a national emergency and the use of funds from a national emergency fund to build the wall, and then an agreement that ends the government shutdown that excludes funding for the wall, I definitely do not believe that would be a bullish catalyst at all. So I suppose that it's the devil's in the details of how that happens, but most likely, given what we're seeing right now, some kind of patchwork resolution to the shutdown I think would be probably a fadeable burst in the market.
Yeah, I keep thinking that we're going to have it on Sunday night, and we're going to have this big spike in the futures on Sunday evening, and we're going to come in, and that could seriously be a selling opportunity come Monday morning.
Right.
Not particularly this Monday morning, but I just you know how that sets up time and time again, where you get the good news coming out on Sunday, and that
was just like the G20.
Yep, absolutely, and it's crazy. It happens quite frequently, and probably because I'm expecting to see it, because I'm the first one in. I'm gonna have to report on it. I just haven't seen it yet, so maybe they're playing tricks on me.
Yeah, right.
So, all right, Brett. Well, I think we've covered pretty much everything that I had on. Gavin, anything you have?
No, great as per usual, Brett. I mean, been all over this little bubbling. I guess this would fit into your frog metaphor for the action we've been seeing over the last couple of sessions. So nice calls there.
Boiling the frog, yes.
All right. Well, we'll definitely have you back on, especially if we're up there testing that 50-day in the S&P, or if we have some new developments and you've got all these trades going on. I'm going to have to get you back on again. But as always, Brett, thank you so much for getting us some color on what your thoughts are, and have a good one, man.
You too. Thanks, Jim.
All right.